So as we approach the end of summer 2025, what in the world is going on with real estate? Well, let's find out. Let's look at some of the issues that are taking place and what's causing these issues to take place. So I am Justin Miller, principal and co-founder of the Chung Miller Group, and every month I bring you a market update. And the market update, I look at data for the month prior. So this is the September 2025 market update, and I'd be looking at the August 2025 data. And I make comparisons month to month, so from July through August, and I make comparison year over year, so August 24 through August 25, okay? And that provides some really insightful information about what's actually taking place at the particular moment in time in the real estate market. Now it is, of course, backward looking. I record these on the 7th of the month or the 8th, so it's the 7th right now, with data that I pulled as of the 7th of the month, allowing us to have a full data view of what took place the month prior. All right, so it's a little bit backwards looking, but it's still extremely current. It's effectively 1 week out of date when I pull the data. So more accurate than you're going to get pretty much anywhere else. I also segregate the data so that I'm taking out the noise that should not be there. And so you actually get a more accurate view and understanding of the market from what I present you than you are from any of the other sources that simply parrot the uncleaned data. All right, so having said that, this month I'm going to do something a little bit different. This is the September market update. I'll give you some statistics on the market as we get to the end of the video, because I think it's important for you to know the details of what's taking place. But in this video, we're 2/3 of the way through the year. I want to talk about what's actually going on, what's driving these trends that we're seeing in the marketplace, because most people don't have any idea what's actually occurring, what's causing the things to manifest that we're actually seeing in the data. Because of my background, having been a business school professor and etc., I have the ability not just to parse the statistics, to look for trends and look for current information, but I have the ability to go back and look at the macro information to inform the marketplace. And so that's what we're going to be doing in this September 2025 market update. So hang with me, because I think you're going to find this really interesting and extremely informative, and probably really helpful to you if you're contemplating engaging in any kind of real estate transaction, frankly, within the next couple of years. All right, so the first thing, I do want to start with a statistic, because I want to point out how unusual 2025 has been relative to where we've been over the past 6 years, right? So we could go back to 2019 and we could look at sort of a normal year. 2020, that was the pandemic, definitely not normal. 2021, 2022, we're coming out of that pandemic. We had a lot of pent-up demand, definitely not normal. We actually saw really high transaction volumes until the middle of 22, when the Federal Reserve decided to start really increasing interest rates. And they pushed those interest rates incredibly high in 2023. And that pulled 2023 transaction volume down to the lowest level it'd been in a generation here in the Las Vegas Valley. And by the way, we're not unique, right? We have our own statistics, we have our own issues, but this actually was the lowest transaction volume across most of the country in 2023. Well, in 2024, we saw in about September of 24, we saw the Fed start to cut interest rates, and that boosted sales a little bit for about 8 weeks during 2024. And we saw volume, because of that, go up from effectively flat to 2023 to go up and finish the year about 2.1% higher than we had seen in 2023. 2024, 2.1% higher than 2023 for single family resales here in the Las Vegas Valley. Well, I've gone back and I've done the same type of statistical analysis again, and I've accumulated all of the single family resale sales that have taken place from January 1st through August 31st. So how do we look? How do we compare to 2023, the lowest transaction volume year that we saw in Las Vegas in a generation? Well, you're not going to believe this. We're 3.2% fewer transactions, single family resale, residential in the Las Vegas Valley, than year to date than what we saw over the exact same period of time in 2023. We're running literally at generational lows in terms of volume. 3.2% slower than 2023, the slowest year we had previously seen in a generation. And how do we compare to last year, where last year was just slightly better than 2023? We are down 5.4% compared to 2024, right? Because 2024, we bounced up on transactions, and we're down here. So as we bounced up, that means that the gap got bigger. We're 5.4% fewer transactions than we saw in 2024. Now, what's the reason for that, right? So we could think of a couple things. We could think maybe prices have gone up higher, and therefore affordability concerns have become greater. It's harder to purchase a place if the prices keep going up. All right, but actually in 2024, price for 4 or 5 months of 2024 was $470,000 for median single family resale. Much of this year, we've been 5,000 above that. We actually ended August at 470, right? So price is the same as where we were in 2024. So price cannot be the explanation for why we're down 5.4% on transaction volume. Well, maybe it's interest rates. Interest rates are really high. They are. Interest rates this year have been between 6.75% on the low end and 7.0% on the high end. Very much in line with all except for a 6-week period of time in 2024. So interest rates are the same. Purchase price is the same. Interest rates are the same. That means carry cost on a purchase the same as we saw in 2024. Yet we are down 5.4% on transaction volume. So we need to dig a little bit deeper into what's going on in the larger environment to explain what's so negatively impacting the housing market. Right? That's a big drop in the number of transactions. There's got to be an explanation for it. It cannot simply be housing prices went up because they didn't. It cannot simply be interest rates went up because they aren't. It cannot simply be there's fewer people living in Las Vegas, because that's not true either. There are more people, not a lot, but there are more people living in Las Vegas today than there were last year. Every single month, Las Vegas population increases. And yet, the number of sales transactions, completed sales transactions, has literally been falling. Let's talk about things that are driving the market. And I'm going to suggest they are fear and uncertainty. Okay, so how do we measure these fear and uncertainty issues beyond looking at the shadow data, right? The statistic that comes out of that of decreased transactions. Well, we could look at increased unemployment levels. We could look at comments that are coming out of the Federal Reserve or out of the political environment. Those aren't identical environments, but they both exist. We could look at the types of governmental issues that are taking place here in the Las Vegas Valley. And we can see, so for example, we can also see it in tourism spending, right? Tourism spending in Las Vegas through the end of August is down almost 10%, right? Visitation, airport flights in and out. The only thing that's really up is gambling take in the different casinos. right? All the other tourism numbers are down between 8 and 10% year to date. And by the way, international tourism is down even more, and international tourists tend to spend more here. Now, does that mean our economy is breaking or we're going into a recession? Breaking? No, absolutely not. Recession? We may already be in a recession. What is a recession? Well, a recession is generally thought of as being 2 consecutive quarters where GDP growth, right? And GDP is normally looked at nationally, but we could look at a regional GDP number, gross domestic product number, where we see that go down for 2 consecutive quarters. So basically for 6 months of a year, right? But that's an informal definition. Recessions are actually defined literally by a group of academic economists, and they look at growth numbers, but they also look at employment numbers to decide whether or not employment's going up or down, and they can use that to define a recession. They can look at a couple different indicators. Well, here in Las Vegas, big headlines occur sometimes. Oh, we've got higher unemployment than around the rest of the country. That's partly the structure of the Las Vegas economy. We get a lot of new people who move here to Las Vegas all the time, right? And unemployment is not just like one big number. It's actually comprised of a set of different types of numbers. So there are the structurally unemployed. There are people who are unemployed because of friction. There are people who are unemployed for various reasons. Well, frictional unemployment is something that we have a lot of here in Las Vegas because we get people who move in, they don't yet have jobs. That's friction in the way the economy works. If they all moved here and had a job already, we would have lower unemployment. But because people move here and may seek job opportunities as they get here, that means we've got a larger group of people who are always coming in looking for work, meaning our unemployment levels are higher. So in that regard, higher levels of unemployment are not a bad thing, right? It's just simply a feature of the way the economy is structured here. Structural unemployment goes to skill gaps, right? So Las Vegas's, Chamber of Commerce and et cetera, have been trying to diversify the Las Vegas economy, because we're obviously highly reliant on tourism. Well, now, whether within tourism or not, we're more reliant on sports competitions, we're more reliant on technology, we're more reliant on light manufacturing, where there's been a lot of small manufacturing plants opening in the Henderson area or up in the Apex area, a lot more dependent on distribution logistics jobs than what had been historically in Las Vegas. So that just simply would then be reflected in structural unemployment numbers where a job opening exists, but we don't have someone with the skills to fit into that job. When somebody develops those skills, they can match and they're no longer employed, right? So again, a second feature about the Las Vegas environment that suggests in Las Vegas, we're just always going to have higher unemployment than much of the rest of the country. So we do have higher unemployment here, however, and that unemployment level has ticked up some, about 1% over the course of the past year. That's indicative of a recession. Our primary industries, situated around tourism, those are down something between 8 and 10% over the course of this past year. That's certainly indicative of a recession. The real estate industry, we're cruising along at transaction volumes that are the lowest in a generation, right? That means fewer people in the mortgage business are working. That means fewer people who are real estate agents are working. That means there's increasing unemployment in and around construction, real estate sales, real estate financing, etc. in what actually amounts to a fairly significant part of the overall economy here in the Las Vegas Valley. Recession. So, in fact, in real estate, we're looking at depression level activity, not prices, but activity levels, right? We're down really significantly. Employment in mortgage banking is down about 50%. Employment in real estate is down something close to a third now relative to where we had been in 2022. Okay, so significant impacts in residential real estate, and those spill over to the larger Las Vegas economy, potentially signaling that we've actually slipped into a recession here in Las Vegas. Now, if we haven't yet, we will soon. In fact, the entire country is likely going into recession. And this takes us to the next really interesting and big issue. At the beginning of September, we got the unemployment numbers for August, national numbers. Those numbers showed that the August employment levels across the country increased by 22,000. Now, that's interesting. It sounds like, oh, well, that's not bad. It's not a lot of jobs, but it's going up. Actually, in the US economy, if we're below about 110, 115,000 jobs created during any particular month, that means that the unemployment level is actually increasing, right? Because the population is increasing. And so we need to grow jobs in order to have employment levels remain steady. Well, we weren't at 110,000, we were at 22,000. Now, when the employment numbers are released on that first Friday of every month, the prior 2 months receive revisions so that the initial counts, if they're inaccurate, can be updated. The revision to June actually showed that the employment level, the number of new jobs created during the month of June of 2025, nationally, was down 13,000 jobs. Now, that was a pretty normal size of revision, about 23,000, 24,000 job revision from what had been previously reported. But it meant that actually for the first time since December of 2020, we saw the US economy losing jobs during a month instead of gaining jobs, right? And if we go back a couple of months prior to that, so for most of 2025, we've been running at job gains, and we could add them together. They have been below 110,000, 120,000 jobs that we would need to keep the unemployment level steady. Right? And by the way, when the unemployment report comes out, it comes out with two numbers. One is the number of jobs gained or lost. The other is the unemployment rate itself. They come from two different surveys. They correspond, but they're not actual perfect reflections of each other. So the September unemployment rate ticked up from 4.2 to 4.3%. That's actually still a really low unemployment rate. Does not suggest that there's problems in the economy. But the job gains were very small. And something that the Federal Reserve noted, and it's been noted more widely, but noted within the past month, there's something strange taking place in the labor market. So the labor market is the total pool of people who are actively working or actively looking for work and currently unemployed. The labor pool has shrunk by numbers that are not fully clear yet, but between about 1.3 and 1.8 million people since the beginning of 2025. It's speculated that this is actually related to immigration. Obviously, the current administration is trying to deport a lot of people. But there have been a lot of people who've just simply decided it's not worth being here in the US any longer, and they've removed themselves from the country. And according to the Department of Homeland Security, that number is actually about 1.6 million people have taken themselves out of the US economy so far in 2025. And so the Federal Reserve noted, we've got this interesting thing where job gains have been so weak in 2025, in the aggregate so far, that we should be seeing higher levels of unemployment. But because people are removing themselves from the economy, removing themselves from the US, that means there's fewer people looking for work, which means there's fewer unemployed people. And so we don't see unemployment rates going higher significantly. They've gone from 4.1 earlier in the year to 4.3%, suggesting there's actually a lot of challenge in interpreting the numbers around employment in the US economy right now. But there could be further challenges in the US economy about structural unemployment, about finding the people who have the skills or the desire to work in the jobs that actually exist. And so we could start to see some really challenging employment issues taking place as we continue through this year and go into and through 2026. So what does that mean? Well, net, it means that employment has weakened, and that is causing some pressure on the US Fed to say maybe we need to start lowering interest rates. Obviously, there's a lot of political pressure on the Fed as well to lower interest rates. If you've been watching my channel for a while, you know I'm not a big fan of the Fed. You know I thought they raised interest rates far too quickly, much too high, and they left their rates too high for too long. You know that in the prior cycle, I thought they lowered interest rates too quickly, too far, and they left rates really low for a long period of time. And in fact, we see this recurrent issue with the US Fed is they are actually slow to respond. They don't like to adjust interest rates a small amount on a frequent basis. Rather, they like to change interest rates significantly too late in the business cycle to be able to deal with things. Well, where do we find ourselves now? We find the Fed is going to be lowering interest rates. Now, they did lower interest rates actually about 12 months ago. Last year, around this time, the Fed was engaged in a process of lowering interest rates. Interestingly, now at this time, the Fed has been saying they need to get inflation down to 2.0%. And when they started lowering interest rates last year, inflation was down about 2.3, 2.4%. And so they were saying, we don't need to get to the target. We're on track to arrive at the target. We're going to pull inflation down slightly, and we're going to be doing that more slowly so we can reduce interest rates. Well, what's inflation done this year? Well, inflation has gone up to 2.7, 2.8%. It's going the wrong direction according to the Fed's desired 2.0% inflation rate, right? But now they're talking, well, we may have to lower interest rates. So the Fed has a dual mandate. It has to do two things. It's not a super simple job. It's complex. There are a lot of things that take place in the environment that are 100% outside of the Federal Reserve's control. And the Fed needs to engage in its dual mandate solution using a very limited tool set to adjust where the economy is in terms of its growth rate, which we would see mirrored in employment levels, and in terms of its inflation level, right? And so the Fed has this primary tool, which is the Fed funds rate. The Fed funds rate is effectively an overnight lending rate that's charged from one bank to another bank, okay? That's the only interest rate that the Federal Reserve directly controls. And so they also have a jawboning, frequently called, a bully pulpit on which they can stand to declare, to express, this is what we'd like to see going on with interest rates. Right? We'd like to see interest rates come down. Oh, great, the Fed wants interest rates to come down. In fact, in the bond markets, there's always been the mantra of don't fight the Fed. If the Fed wants to see interest rates come down, the bond market usually corresponds in their thinking and starts to bring down interest rates. How does the bond market do that? By demanding more bonds, right? So demand for bonds goes up. That causes the price of bonds to go up, and interest rates are exactly inversely correlated to the price of bonds. So that bond prices go up, interest rates come down. So when the Fed says, we want to lower interest rates, bond traders start thinking to themselves, maybe I should buy bonds right now, lock in higher rates, And as other people start jumping in to buy more bonds, my bond prices are going to go up. And so I could sell them and make a profit, as well as having, if I don't sell them, locked in a higher interest rate, right? So when the Fed says we're going to lower interest rates, it creates demand within the bond market, and bond traders, bond investors go out and start buying bonds. Same thing if the Fed says we're going to raise interest rates. Bond traders get scared, if you will. And they say, you know what, I don't want to be seeing my bond prices going down because I'd be losing money. So I'm going to sell my bonds. I'm going to try to sell my bonds once the Fed starts to say they want interest rates to go up. And if you sell bonds, you're creating more supply. That means the prices of bonds are going to be coming down, and that means interest rates are going higher because, again, interest rates are exactly inversely correlated to the price of the bonds. Okay, so the Fed has this one control lever in addition to jawboning. They can control the federal funds rate, right? And they meet 10 times a year. The Federal Open Market Committee, FOMC, meets and makes a decision, a voted decision, exactly what that Fed funds interest rate is going to be. They decree that, they publish it, and that's what it is. And they tell people in the release of the minutes of the meeting, perhaps in a news conference at the end of the meeting, and also through what's called the Beige Book that the Fed puts out several times a year. The Fed Beige Book gives actually a lot of really deep, interesting data about the economy, but it also talks about what the Fed is thinking forward and wanting to do with regard to interest rates. Okay, so it's a very blunt tool that influences interest rates. The Fed in 2020 decided, we need to lower interest rates dramatically to save the economy because the government has shut everything down for the pandemic. And then they decided in 2022, wow, we've got inflation. We need to start increasing interest rates. And they did so very quickly, quite dramatically, and to a high level, right? And so we've been whipsawed between these two things, near 0% interest rates and over 7% interest rates in the mortgage market, right? The Fed funds is whipsawed like that as well. On the one rate they control, but through jawboning and something else, they've managed to influence significantly long-term interest rates. Well, now, what are we actually looking at? We're looking at unemployment numbers likely to start, starting to go up, right? The rate's going up. We're likely to start to see actual negative growth, actual job losses, net, in the US economy from here forward through the end of the year and quite possibly through a significant portion of 2026. Clearly, the economy is weakening, right? Regardless of whatever political theater you want to actually listen to, the US economy is weakening. All right, so we've got unemployment going higher. How does the Fed deal with increasing unemployment? They cut interest rates. Well, why would that help resolve unemployment? Because it makes money cheaper. Remember, interest rates, just the price of money. If you can go out and you can borrow money to build things, to buy things, your ability to engage in economic transactions increases. And so you start to buy things, you start to build things. That means you need to get people employed to build those things, to supply those things, to transport those things that you're going to be buying, right? If the unemployment level is too low, too many people are fully employed and there's not enough people to fill all the job openings, that's when the Fed decides we need to slow the economy, and so they start increasing interest rates, right? So it's an inverse process around employment levels. Well, what about with the other part of their dual mandate, inflation? If inflation goes up, they want to increase interest rates in order to drive down the pace of the economy to lower inflation levels. All right, so what's going on right now? Well, right now we've got inflation going up. Right? It's not real high. It could get considerably higher, but it's not real high. It's about 2.8% as I record this in the early part of September of 2025. It's considerably above, right? I mean, that's what, 40% higher than the desired 2.0% level. So it's actually quite high relative to the Fed stated desire of 2.0%. We're 40% too high on inflation. All right, so as inflation is high, to get inflation under control, the Fed increases interest rates. But we've got increasing unemployment. As unemployment goes up, to grow the economy, to bring unemployment lower, the Fed lowers interest rates. So right now, the Fed is in this conundrum spot where the prescribed method for dealing with the two problems in the economy, higher inflation and lower employment, are actually pulling them in exactly the opposite directions. Well, a couple questions arise. One of the questions that arises is actually, what's worse for the economy? High unemployment or high inflation? It's kind of interesting. If you're unemployed, that really sucks, right? I mean, that's really bad. It's bad for you, it's bad for your family. There's no question. And the harm done through unemployment to those who are unemployed, very real, right? Psychologically real, economically real. It can be devastating. But how many people are unemployed? So if we start spreading the unemployment consequence across the US economy, unemployment levels that get up to 10%, really devastatingly bad, right? Right now we're at 4.3%. 10%, very unusual, suggests huge weakness in the economy, right? But it's 10% of people are, so it's actually, it rotates because people find jobs and other people become unemployed, but it's perceived to be something in the sort of 17 to 21% of people would experience unemployment during the course of a year in a 10% unemployment environment. Okay, that's really bad. But what about inflation? Well, inflation impacts every single person in the economy, right? The price of bread goes up, the price of eggs goes up, the price of going out to eat goes up, et cetera, et cetera. Inflation impacts every single person in the economy. And so usually when the Fed has to make a choice between supporting employment and fighting inflation, they are going to choose to fight inflation. Well, that suggests right now, all else equal, the Fed might decide they actually need to increase interest rates. Now, I don't think that's going to happen. I think the political environment is so intense right now that the Fed is going to try to lower interest rates and will declare at their September meeting they're lowering interest rates. This might be once this year. It might happen again before the end of the year. We'll see how quickly unemployment or employment levels deteriorate. I think right now the Fed's in a spot where even though inflation is 40% higher than they want it to be, and it's trending in the wrong direction, it's going higher, they feel, well, at least it's constrained, it's below 3%, and maybe we've got room that we can play, and we don't have to worry about inflation getting out of hand. If inflation actually goes above 3.1, 3.2%, that bet becomes really problematic. We're actually entering into a period which is referred to as stagflation. Stagflation is low levels of growth and high levels of inflation. Again, our inflation right now is not that high, and our growth levels are not that low. Our economic growth levels are not that low. But this is a really big change from where we were a year ago. This is a really big change from where we were 24 months ago. A really big change from where we were 9 months ago. The economy is definitely slowing, employment levels are going down, unemployment up, and inflation levels are going higher. This could become a really big problem. Yeah. I say that not to scare you or to bore you. Hopefully you're not bored. But I say that so you know the Fed's actually in this conundrum spot right now. Now they've put themselves into this spot. Don't feel bad for the Federal Reserve governors who make these votes on interest rates, right? They kept the high interest rate too long, which has been problematic for the economy, and the high interest rates are no longer having the desired impact on inflation levels, but they are slowing the economy, which is driving employment levels lower. So the Fed has created this problem for themselves. Now, that's all well and good to say. Unfortunately, it impacts all of us, right? When the Fed makes a decision, it impacts all of us. Well, when the US economy was being shut down during the global financial crisis in 2008, another problem that actually the US Fed created, right? The US Fed was the precipitating actor that created the global financial crisis. And they did that by allowing the investment bank Lehman Brothers to collapse with obviously devastating results. Here in Las Vegas, we experienced it as a collapse in the housing market. It was experienced in different ways across different parts of the country, but clearly housing was, because most people buy houses on loans, very significantly impacted. Well, one of the things that the Fed learned in the global financial crisis is they had another tool that they'd never really used before. And that tool is referred to as quantitative easing, and its inverse, quantitative tightening, right? Kind of like lowering interest rates and increasing interest rates. Remember, the only interest rate the Fed directly controls is a federal funds rate, an overnight lending rate. Quantitative easing and quantitative tightening can be highly targeted at particular portions of the long end of the bond market, right? Not the overnight part, but the 5-year part or the 30-year part, right? So the longer end of the bond market. So what is quantitative easing? Well, that's when the Federal Reserve goes into the bond market and starts buying up particular types of bonds. And they can be very targeted. They could buy agency debt, meaning mortgage-backed securities. Remember, when there's more buying of bonds, prices of bonds go up, which means the interest rate on those bonds goes down. If the Fed decides it needs to tighten, they could sell off those bonds that are sitting in their portfolio, all the bonds that they had previously bought. Because they're selling the bonds, that's pushing prices of bonds lower, which is causing interest rates to go higher. So quantitative tightening pushes interest rates higher, quantitative easing pushes interest rates lower, and it can be directed at very specific parts of the market. So for example, the Fed could decide they want to lower interest rates on automobiles, and they go into the market and they start buying auto bonds. Okay? Probably not what they're going to do. They could go into the market and start buying mortgage-backed securities, mortgage debt, mortgage bonds. And if they do, that would pull mortgage interest rates lower. Now, to the extent that there is absolutely a recession, a bad recession in housing all across the US, is shown in Las Vegas by having lower transaction volume than we had in the generationally low year of 2023 and being down 4.5% on transaction volume from 2024. Right? We've got a crisis in the housing market, and the Fed could go out and engage in quantitative easing, specifically in mortgage-backed securities, lowering mortgage rates. Now, why might that be interesting? Well, A, it's very targeted to a particular sector of the economy, which is really hurting. But B, it would not necessarily lower interest rates generally, which means they don't have to worry about overheating the economy, causing inflation to go higher. Right? They could be more surgical, and they can do this at the particular time-targeted portions of the market. Now, is the Fed going to do this? Oh no, The political pressure right now on the Fed is they need to lower the Fed funds rate. It's actually a really, really bad prescription because we don't want inflation going higher. Right? What we want is we want to take care of certain parts of the economy that are having a really tough time. We'll talk more about just how tough that time is in just a minute. Right? So they could do something with interest rates through quantitative easing that would be incredibly helpful without pushing overall inflation levels higher. Frankly, that's what the Federal Reserve should be doing. You've heard it here first, right? You heard from me at the 2025 market forecast video that I did in November of 24. We may very well be entering into a stagflationary environment during the course of 2025. And one of the very first people who suggested this, well, now I'm suggesting what the Fed really ought to be doing is they ought to be engaged in quantitative easing, specifically around mortgage-backed securities. The Fed funds rate can stay where it is. It won't matter, right? Because banks lending to each other overnight does not actually really drive much economic activity. If we can increase the activity that's taking place in the real estate business, that increases mortgage broker employment levels, real estate agent employment levels, appraiser employment levels, title company employment levels, et cetera, right? There's actually a lot of people who are engaged in the totality of real estate activity. Mover people would need to be more employed, furniture manufacturer people, et cetera, right? This could have a really significant beneficial impact on a lot of the sectors of the US economy that are somehow related to real estate. Will the Fed do it? I don't know. Clearly, they don't listen to me for advice, but whatever. That's what they ought to be doing. Now, let me just give you one other really important insight into what these high housing interest rate numbers have meant, the high interest rates on mortgages, and frankly, the high interest rates that exist on investment debt for companies building new factories and things like that. Right? There's a lot of desire for companies to build new factories. That's great. Well, it doesn't happen overnight. And in fact, when a company builds a new factory, they're probably borrowing the money to do it. And the more expensive that money is, either the smaller the factory or the longer it takes to get everything through the approval process to build the factory, or maybe it just doesn't get built, right? So driving down these long-term interest rates could be really beneficial. Well, what's this other insight? According to data from the US Fed, right, and this is really high quality data, right? The Fed is this significant statistically directed organization that invests a whole lot of money into really understanding what's going on in the US economy, irrespective of whatever political attack wants to be made by any particular person or entity at any particular time. The data that comes out of the Fed is extremely high quality, even though the Fed is prone to making some really consequential mistakes. There are other places in the US government from which we can get really high quality data as well. The Bureau of Labor Statistics, the US Census Bureau, there's a few of them that give us really insightful, really important, really helpful information to understand what's actually taking place. Well, this data in the aggregate is showing that economic mobility, measured in a variety of different ways, in the US has fallen to the levels that we haven't seen since the end of the Great Depression. What's economic mobility? Well, a lot of people grow up in an environment where there's not a lot of jobs. And so they move to where jobs exist. Or the types of jobs they want don't exist around them, and they move to where those types of jobs exist. Or people form households, right? Johnny grows up, turns 25, gets married, decides to start having children. Johnny would like to go out and buy a house or rent a house right? Live somewhere other than the parents' basement. That household formation is a mobility issue, right? So we've got a variety of different ways in which we can look at mobility. One of the real strengths of the US economy since the start of the Industrial Revolution in the late 1700s is the US has experienced greater levels of economic mobility. That's geographically, that's job type, that's socioeconomic status climbing capability, right? You can make more than your parents, your grandparents, etc., etc. In all these measures, the US has experienced greater levels of economic mobility than any other country in the world. That's contributed to rising living standards. It's contributed to rising productivity levels. It's contributed to actually relatively lower inflation levels because you can get more people building more stuff. That's productivity, which means you've got more stuff in the economy for people to buy. That goes to higher quality of living. And you don't have to see all of the pricing pressures because you've got more of that stuff for people to buy, right? Economic mobility has fallen to not just in Las Vegas, right? And by the way, in a place like Las Vegas, which has been growing at phenomenal rates since it was founded in 1915 at 500 people, right? Think about that. In 110 years, the Las Vegas Valley has gone from 500 people to 2.4 million people. That's a lot of growth, clearly. And it's been ongoing and ongoing and ongoing and ongoing. Well, where do these people come from? They come from other places. You need mobility to sustain these types of growth patterns. So Las Vegas itself is it has extremely benefited from this economic mobility. But it's not just Las Vegas. It's the Southwest, it's the Southeast, it's the Sun Belt. It's been a lot of the US, and most industries, right? Where do people come from to work in some technology industry that 3 years ago didn't exist, right? Not just the company didn't exist, the industry itself didn't exist. Well, they've got to be moving from somewhere else. They've got to be moving from another industry. They've got to be going to school and moving out of the schools and into the workforce. Those are all mobility issues. High interest rates for a prolonged period of time, as well as several other really bad policy features over the past several months, which has exacerbated this problem, has led to the lowest economic mobility that we've seen in the US since the end of the Great Depression. Hugely, hugely problematic. Does that impact us? Yes, absolutely. Does it impact us here in Las Vegas? Absolutely. Okay, so having said that, right, kind of bleak right now. The Fed really needs to get its act together. Frankly, Congress needs to get its act together to come up with better fiscal policy so that we can actually do things properly in this country to start to encourage people to go to school and get degrees in appropriate things and get into the workforce and be able to move to take jobs because the jobs are opening, and et cetera, et cetera. So what's the August 2025 numbers start to look like in Las Vegas? Right, because I don't want you to think everything's collapsing, it's going to shit, and nobody's going to be buying houses, and et cetera, et cetera. There are still people who move here. They need to have housing. There are some people who have existing housing, and for various reasons, they need a change in that existing housing. They need something bigger, they need something smaller, they need something in a different part of the Las Vegas Valley because of commute issues, whatever it happens to be. There are people who need to buy property. There are also people who need to sell property. And most of the voluntary, like, I could, but I don't know I need to, transactions have evaporated. And we're existing, and I've been saying this for several months now, we're existing at the need to participants, buyers and sellers in this economy, are engaged in the activity of buying and selling. And that's it, right? So where are we? Right, with need to buyers and sellers, In the aggregate, so far this year, we're down 4.5% on transaction volume from last year. So let's look at pricing. Pricing, single family residential resale in the Las Vegas Valley at the end of August of 2025, $470,000 at the median. Okay. Now that is down. It's actually down $6,000 or 1.3% from where we had ended July of 2025. We're down 2.1% year over year, so from where we were in August of 2024. But I want to caution you, in August of 2024, we saw a spike higher by about $10,000 from what most of 2024 was, which was $470,000. So if we were comparing to 5 of the months of last year, we're actually flat. Prices are flat. Right. So far earlier this year, we've been up 1.5% year over year. Right now, we're down 2.1% year over year. But again, it's because we saw a 1 month spike in August of 2024. So prices continue to be at the single family resale home flat. Right. So it's not that prices are going higher, they're flat. Okay, well, what about for condos? Condos, we've got a little bit different situation here. Now, remember, single family homes make up about 86% of all residential units in the Las Vegas Valley. So condos and townhomes are a much smaller market share. And so they can fluctuate a lot more with relatively minimal impact on the overall real estate market. But of course, if you want a condo or you want to sell a condo, you're impacted by this greater level of volatility. So condo prices at the end of August came down $7,500 to $230,000. That's down 3.2% month over month and down 3.0% year over year. So condo prices a little bit weaker, but we're not seeing anything exceptional here, right? This is not much divergent from, okay, we're approximately flat like we are in single family homes. Townhomes, a little bit different. In townhomes, we have been doing fairly well most of this year. We came down $10,000 to $335,000 at the end of August. Because in July we're at 345. We came down 2.9% month over month. We're down 1.5% year over year. So again, looking at kind of the annual, right, which takes out all the seasonality issues. Some months are hotter, other months are colder, blah, blah, blah. We're down marginally from where we were last year. I don't think that's anything to be concerned about. I don't think there's some decreasing trend in place, anything like that. Prices are approximately flat. Okay, so that's that. Well, what about demand, right? So we know in the aggregate demand so far this year down 4.5% from where we were in 2024 year to date. Well, single family resales in August of 2025 came down 206 to 1,631. We came down 1.2% month over month. We're down 12.3% year over year, right? So in other words, the numbers in August helped pull us even lower. When I did the initial calculation, only looking through the end of July, we're down 4.3% year over year. We're down 4.5% year over year now, right? In other words, so August is actually even worse year over year comparison than what we had been earlier in the year. So no help there. All right, what about condos? Well, we came down 54 condos, which is 20.1%. We only had 215 closed condo transactions that took place in August. That's down 31.5% from the number of transactions that we saw last year. Remember, last year was just barely better than 2023, which was the slowest year in a generation. So we're down really substantially from where we were last year with regard to condos. So that's something to pay attention to. I don't think condos are going out of style, but if we think about condos as running at 230,000 median sale price relative to 470,000 median sale price on a single family home, means condos are less than half the price. That suggests that people at the lower end of the socioeconomic status level right now may be having a harder time with what's taking place in the environment, and therefore having a harder time actually making those transactions. Well, what about townhomes? Townhomes maybe gives us a partial insight into this. Townhomes down 18 to 181 townhomes closed in August. That's down 9.0% month over month. Interestingly, though, it's up 7.7% year over year. So we've got condos at 230, we've got townhomes at 335, and we've got single-family homes at 470. Right, so you can start to see that different economic strata that exists across these market subsectors. Okay, so townhomes not hurting in terms of transaction volume, although I'll caution you, transactions in townhomes last year were really quite weak. Right, and we did see townhome pricing come down. It's weak. It's not strong. It's not falling. It's down 1.5%. But so it may not be actually at the lower socioeconomic status level so much as at the low socioeconomic status level, the least expensive condos, where we may be seeing the most deterioration in the market right now in terms of transaction volume. Okay, so a number of things I'm not going to go into this month because I don't want the video to get to be too long, and I thought the early stuff was really important to highlight sort of what's going on that's causing these problems in the market. But I do want to talk about inventory, and I'm not going to talk about real and fake inventory this month. I'm just going to talk about the listed inventory. Single family residential inventory down 172 in August, down to 7,312. That's down 3.1% month over month. That's a pretty big drop at this time of year, right? Seasonally, we don't expect to see lots of growth in inventory in the August timeframe, but we should not be seeing a decrease in inventory. By the way, we're up 21.5% year over year on single family inventory. And again, this is reported inventory. So part of this is real, part of this is fake, right? If we think about sort of the past couple of months, I've been highlighting a third of inventory that's listed as just fake, right? But we don't know. I didn't do that particular data analysis this month. So inventory is up, single family residential resales 21.5% year over year. Condos, condo inventory came down 123 to 1,546. That's down 7.4% month over month. Of course, we are up year over year. And you'll remember, we just had really, really weak inventory numbers last year. So we're up 18.4% year over year. Townhome inventory also came down 23 or 2.0% to 1,123. Condo inventory went up by 70.7% year over year. Now, two insights I want to give you here. All three of these market subsectors, we saw decreasing growth relative to the relative to the prior year for each of the past 4 months. So we've not been growing inventory since May of 2025 relative to where we had been the year prior. Okay, so yeah, we're up, but we had been up by over 33% on single family homes. Now we're up 21.5%, right? We see this pattern We've seen this pattern taking place each of the past 4 months, and I've pointed it out each of the past 2 months, specifically because it's interesting that gain has been decreasing in scope. It's significant. We've actually seen significant drop in relative gain of inventory over each of the past 2 months. We've seen it over each of the past 4 months. And so something to keep in mind. The other insight I want to give you here is relative to newly listed. This is existing homes that have newly listed into inventory over the prior month. We actually saw single family and condo new listings come down in August from what they had been in July. Only in townhomes do we see any increase in new listings. We got an increase of 12 new listed in August relative to July. Okay, so that means that the inventory information out there, that we've got all this inventory, continues to just be fake news. We don't have all of this inventory, and I have not even parsed this between fake and real this month. Our inventory growth is slowing. Our new listings are going down. Inventory remains tightly constrained in the Las Vegas Valley. Now, some people talk, is it a buyer's market, is it a seller's market? If it's too much inventory, it's a buyer's market, right? Because there's not enough buyers competing for all the stuff out there, and so sellers have to lower their prices to get a sale. That's referred to as a buyer's market. The truth is, to see a buyer's market, we need 5 to 6 months worth of inventory. We're sitting at around 4 months worth of inventory. We're higher than we had been over the past few years. We are not in a buyer's market as such. And buyers who try to go out there and get, like big discounts, you're probably fooling yourselves. Now, we do know there's a whole lot of fake inventory, so there's a whole lot of price cutting taking place on the list price because people are just priced, without any regard to where transactions are actually taking place. But we also know that where those transactions are taking place, prices are coming down just very slightly. And I don't think there's a trend. Prices came down 1.3% month over month in single family homes to 470, so the exact same level that most of last year had been at. Prices came down 3.2% in condos. Prices came down 2.9% in townhomes. I don't think we're seeing a trend of prices going down. I think that we're seeing kind of pricing maintaining at about where it's been for the past approximately 21 months. Okay, so that's what's going on in the market with significant background about what's driving that. Where does this go forward in time? Well, if the Fed cuts the Fed funds rate, great. That may lower mortgage interest rates just slightly because people in the bond market decide, oh, the Fed's signaling something and I want to respond to it. Sometimes the bond market responds in the opposite way from what the Fed wants. When the Fed was cutting the Fed funds rate last year, we actually saw mortgage interest rates going higher. After an initial 6-week drop, we saw the mortgage interest rates go back up to 7%. So we could see a very small window where mortgage rates drop if all the Fed is doing is cutting the Fed funds rate. If the Fed actually does what I'm suggesting, where they start engaging in quantitative easing in the long-dated maturity of the parts of the bond market, and specifically in mortgage-backed securities, we could see substantial decreases in mortgage interest rates, which would be very supportive of the housing market, which would actually cause us to start to experience both increasing sales and rapidly depleting inventory because there's not much inventory out there. And by the way, as we go into September, October, November, December, those are months that seasonally, historically show decreases in inventory, right? So we could quickly eat through inventory and end up in a very tightly constrained market if the Fed actually engages in quantitative easing around mortgage-backed securities. So that means prices will start going higher. Now, I'm not specifically predicting that. I don't think the Fed is going to do what I'm suggesting that the Fed does, which is actually the correct prescription for how to fix a lot of the things that are ailing the economy right now. I think they're just going to bow to political pressure and we'll cut the Fed funds rate 25 basis points and, call it done. We'll see what actually happens. Okay, so if you find this kind of information helpful, useful, please share it with your friends, your neighbors, your friends, your colleagues. Please smash the like button, hit the notification bell, subscribe if you've not already, and please leave comments. I'd love to hear from you about the analysis about these bigger issues. I know this is a real estate market update, but the real estate market is impacted by a whole bunch of things that are not specifically within the real estate market. And I think it's important that we start looking at these things and analyzing these things to have greater insight about the direction of the real estate market itself. Okay, I am Justin Miller, principal and co-founder of the Chung Miller Group. We help people build wealth through real estate. We help people buy and sell homes here in the Las Vegas Valley, whether primary, secondary, or investment property homes. I will see you in the next video.